Okay, hello, welcome everyone. We're getting ready to start our webinar, The Financial Side of Your Business. We will be starting today at noon. It is now 11:57, so we have 3 more minutes. So get comfortable, sit back, relax. We're intending to go for about an hour and a half, not longer today. And I'll just wait for the crowd to assemble out on their personal computers, and away we'll go in about 2.5 minutes. So just wanted to let you know you've come to the right place, and we will be starting on time. Okay, 2 minutes to go. Be starting at noon. Welcome everyone. This is kind of our countdown, but I want to put this slide up so that those who arrive a few minutes early realize they've come to the right place.
Yeah.
Okay, we've got 1 minute to go, and I can see that the audience is filling up out there. This is great. We're going to have a good webinar, talk about finance, and hoping you can take something away from this that'll make your business run better and more profitably.
Especially under these times of uncertainty.
Right. This is being co-hosted. You see our names probably. Bill Nicolai, that's my partner here. And I'm Bill Petrovic. We're getting ready to start at noon. And the internet clock on my computer just rolled over to 12. So here we go. Thanks for coming. Thanks for coming on time. I always can see how the numbers are going with the attendance, and I'm used to a few people rolling in late, but that's okay. Want to introduce myself. I'm Bill Petrovic, and welcome to this SCORE webinar. SCORE is a volunteer organization here in Indianapolis. We do mentoring and we do workshops, which are now all webinars due to the COVID crisis. Our mentoring is being done by way of Zoom these days. 1-hour appointments, they're always free. And you can learn more about that by visiting our website, which is indianapolis.score.org. And that is going to be on the last slide as well, if you didn't catch that website. I want to mention Bill Nicolai. I'll let Bill say hello here.
Yes, good morning. My partner and I are both corporate controllers. My experience took me to the international realm, and I look forward to learning a little bit more and sharing our thoughts with you this morning.
Okay, and Bill didn't mention this, but Bill is bilingual and has also offered mentoring in Spanish. If that is something you'd be interested in, he would be your mentor. So Bill, let's go to the first slide and we'll get started here. So today we're going to be talking about the finance side of your business, and as we go along, if you have questions or thoughts, feel free to either use chat or Q&A and we'll try to get a dialogue going where it's relevant. I remember this webinar was our last workshop that we did before COVID. Bill and I were there at Glendale in the library, in the community room. I believe it was on a Saturday morning. And it seems like a long, long time ago. That was in March. And there was exactly one person in the audience with a mask on. And I said to myself, what's that guy doing with a mask on? Wonder what's wrong with him. Now, when I go into a store and there's somebody without a mask on, I say to myself, what's that person doing here without a mask on? I wonder what's wrong with him. So times have really changed. And fortunately, Bill and I have survived up to this point, and so have you as you attend this webinar, but we're ready to go. So we're going to be talking about the finance side of your business, which for a lot of people who are starting businesses is the more mysterious part of business. Generally, people start businesses, they are coming from the sales and marketing side of things, or from the operational side of things. They've invented something that they want to sell. They're making something, but the finance part is maybe the little bit more mysterious part. And I hope that those people who find it confusing or mysterious or unknown are the ones that are attending today, because we're hoping to give you some basic information so you can feel more confident and strengthen your business. So this slide talks about the various tasks that have to be handled on the finance side of business. And for most people, some of these are being handled and some of them aren't. And if they aren't, it could be a vulnerability that you want to patch up. So top of the list is record keeping. I'm calling it bookkeeping. Some people might think of that as accounting. And it all ties together and it leads to your financial statements. Again, each of these topics will be a slide or two in and of themselves. So I'll just march down the list here. Cash management is part of finance. You know, who's making sure that you're not overdrawing your bank account, that you have the money lined up to grow the business. Debt management is something that needs to be managed. If you have a loan outstanding, then you have some responsibilities to make sure that you're generating the cash necessary to make those debt payments. Budgeting is something that I've learned from mentoring for the last 7 years is very rare in small and medium-sized businesses, and is an extremely important tool that you need to consider seriously if you want to take your business to the next level. Banking relationships are key to the finance side of the business, and there's some specific topics that we want to cover on that basis. Funding, bringing money into the business, either externally, debt or equity, or internally through retaining money in the business rather than withdrawing it as the owners are entitled to do, is something we want to talk about. Purchasing, supply chain, inventory control, a few minutes on leasing versus buying, and then finally taxes. So these are the topics. We're going to cover them all. They fall into the category of finance. Okay, so let's talk about record keeping. A lot of times when I have a new business and I'm mentoring them, maybe they've been in business for 6 months or less. They've come to SCORE because they've now accumulated some questions. They are confused by something or other. They want some guidance on the best methods. I always ask them, well, how are you keeping your records? and I get a lot of different answers, all the way from package. It's called QuickBooks. We set it up. I got trained on it, or I have somebody who's helping me with that. So there's a broad spectrum there, but somehow, some way, you have to keep records. You're not going to be entitled to take your expenses for tax purposes unless you have records. You're not going to know how you're doing unless you have records. And as shown at the bottom of this slide, these could be paper, pen and paper, really. You could do that. Spreadsheet, which is Excel, or software. There are packages for this. So do not think that at least on day one, you absolutely have to have software to do this. Keep in mind, accounting is as old as civilization. I mean, even the Romans did accounting, and they had no spreadsheets or software, but it got done. So you have to keep track of what money is coming in and what money is going out. And on the revenue side, if you can create some categories so that when you look back on the revenue streams, you can get as much information as possible out of that, all the better. So, for example, if you have multiple product lines, let's say you're in the home improvement business, you might have product line where you're doing kitchen remodels, or bathroom remodels, or deck building, or roofing. Those are separate product lines, and it's nice to know when you have the revenue where the money is landing so that you can look back and see how well you're doing. But you have to keep track of every penny that's been billed out. On the expense side, you want to keep track of all of your expenses so that you are entitled to deduct them from your revenue to create as low a tax liability as possible. So you're not doing anybody a favor by just saying, well, I'm just buying this equipment. I'm not going to charge it to the business, but it's for the business. I don't know why people would do that, but you've got to have the records and receipts, invoices, that sort of thing. To dig into that a little deeper, you also need to understand which costs are a variable versus fixed. And the reason I say that is the variable costs are the ones that when you have sales, they're directly related. Simple example, if you're selling blue jeans, the revenue from selling the blue jeans might be $40. The expense of the blue jean itself might be $30. That's a variable cost. You don't have that cost until you sell the jeans. And when you do, then you have information about the revenue is what you sold it for, and the variable cost, what it costs you. When you deduct those two items, you get something called a gross profit, which is sort of a halfway point on your income statement that indicates how much money is left over to pay all your other expenses. And those we're going to refer to as fixed expenses. So all purchases, physical items, services, need to be recorded. Your payroll expenses need to be recorded. And on the travel side, I'm not so much thinking about taking a trip for business, but just moving around for your businesses. Quite a few businesses involve services, and services almost always involve you going to them. Again, I mentioned home repair, but it could be a lot of other stuff, in-home health care, mobile, dog washing, all that sort of thing. Even business mileages occur if you're going out and shopping for the business. So get in your vehicle, go out to Menards, buy your supplies, and bring them back. Those are business miles. And quite often businesses share between personal use and business use of vehicles. And in most cases, the best way to handle that is keeping track of the mileage that you're using for business. And the IRS will allow you to deduct that. At the end of the year, they'll tell you how many cents per mile you're allowed to deduct for your business mileage. There's also other items that you might be writing checks for that aren't technically expenses. They're deposits and prepayments, but you need to keep track of those so that you can build your financial statements. So this is the foundation of your business, is keeping records. And you could quickly move from paper to spreadsheets to software as things get going. You could start with software, but the important thing is to keep records and to keep them accurately and to keep them current. People tell me, oh yeah, well, I really don't keep the records that much. I sort of save all these receipts and I just give them to my accountant at the end of the year and he figures everything out. And that is a big mistake because the accountant is doing clerical work for you by sorting this all out, but charging you at the accountant's rates. And also, you don't have any idea. You're flying blind. You don't know how your business is doing till the accountant gets back to you. So you really need to keep your business records very current, at a minimum, recording everything once a month. So that's now been said about record keeping, and we'll look at the next slide here, which is kind of the best practices involved with record keeping. So create a system. You have to have a system. You have to have a process. And eventually you'll realize that you need to create some categories for your expenditures. You don't want your system to be to list everything one after the other, after the other, after the other. You want it, it's sort of like putting things in file folders. You want to have a chart of accounts. And the chart of accounts is categorized by bigger categories. Like you might have a category of insurance, and inside that category you have all your invoices for your business insurance, your liability insurance, whatever else, or another category for payroll expenses. So that's called your chart of accounts. When you're building these systems with software, that's the starting point. They ask you what are the categories you're going to be using. They usually give you a template with some suggested categories, and then you add and subtract from that. But you need to organize your records so that when you look at them, you can get some meaning out of them. You also need to understand what the record requirements are for taxes so that you do not dispose of necessary invoices and receipts, so that you can prove things. If you sell a tangible product, the business becomes more complicated because the seller of a tangible product, tangible is something you can hold in your hand or touch or feel. It's not a service. So if you're selling haircuts, you're not selling a tangible product. But if you have a shop that sells hairspray, that's a tangible product. So the guy comes in and gets a haircut, you don't add sales tax. We all know that. We've gotten haircuts. But if you walk over to the sales shelf and you pick up some product to put in your hair, there's a sales tax add-on, and the barber who's running that shop has to keep track of that, has to collect it, and has to remit it to the state. So if you're selling something that has a tangible product, your record keeping requirements have just become a little bit more complicated. All right, let's talk about the next slide. cash management. So a lot of people feel that they are doing a pretty good job with cash management by way of monitoring their checkbook or their bank balances. And that is a pretty good indicator. If you don't have money in the bank, you got a problem. But it's not the same thing as understanding how much profit you have. And it doesn't really tell you if you're managing cash well just because you have cash in the bank. So one of the rules of business, best practices, is to get paid quickly, as close to the transaction as possible. And if you can collect cash and deposit it immediately, there's really nothing better than that. Checks can also be useful as long as you are not collecting checks that bounce. And I'm reminded of a store in the Evansville area. It was Daywig's Meat Market, and they had a bulletin board at the entrance to the store, and they wrote above it, "Deadbeats," and they made Xerox copies of checks that bounced. And you could walk in there and see the names and the amounts of these checks that people wrote to the store. And I thought, well, this is pretty neat. It's kind of a shaming thing, of course, but these aren't the customers you're trying to cultivate. They're the customers you're trying to avoid. So if you do take a check, be sure you get proper information so that you can identify the person if they stiff you. Credit cards are accepted almost by anyone. You can go to even the farmer's market and they're taking credit cards, and that's good for the customer. It's not so good for the farmer. It's not as good as cash because you have to pay a fee to the bank to be using that credit card, and it's usually 2.5% to 3.5%. And if you know, that's money that's coming out of your pocket. So keep in mind cash is better than credit cards, and also keep in mind that not all credit cards charge the same amount. At the one end of the spectrum is American Express. They charge you the most. And then the Visa, MasterCard are at the other end of the spectrum. They charge you the least. So I always say you don't really need to take 100 different credit cards. If you could take one or two, most people will have that in their wallet. Aggressively collect money owed. We're going to talk about this a little bit more, but if you're letting people pay you on terms, which means you tell them, okay, here it is, your bill is due in 30 days or 10 days or due immediately, try to get that money paid. Try to not let that accumulate. That is money that they're now borrowing from you at 0 interest rate, and I don't think you really want to be lending your money. So have processes where visible metrics and owners means who is watching the bank account, who is reconciling the checkbook, who is negotiating the terms with the bank for the credit card, or at least understanding them, who is calling the customers that owe money and collecting them. That's the least favorite job inside a business, is to pick up the phone and say, you know what? It's been 60 days since we sent you that invoice for cutting your grass. Is there a problem? Didn't we do it right? What's the situation? We really need to get paid. And that's the least favorite job. And guess what? It's one of the most important jobs. So have somebody own that. That needs to be a process. If the accounts payable are piling up, who's going to pick up the phone, and how long do you give them before you ask? Most people now would rather send a text or an email, but guess what? The most impactful way, short of driving over there and knocking on their door, is to pick up the phone and call them, to talk to a real person and get a real answer. So if you get nothing out of this webinar today, think about that. Bottom of this in red, it mentions don't net your cash and your expenses. That means if you're in a cash business, like you have a bar and you have a lot of cash in the cash register and the guy is delivering the beer, don't open up the cash register and count out the money to pay for the beer. Write a check or pay with your credit card. If you net items out, your record keeping is much more difficult to keep. You need information about the bank deposits and you need information about the bills paid. So, okay, let's look at that. And by the way, I'm noticing some questions in the Q&A are coming in, and I see Bill is helping me out by reading them and answering them. And Bill, if there's anything that's a general question that everybody could benefit from, just interrupt me.
Okay. Okay.
I'm talking about cash management some more here. Vendor payments. How are you paying your vendors? Here's where people kind of get caught in the middle. They want to buy something and resell it, but the vendors want to get paid the minute they drop it off at your door, but you haven't sold it yet. So that puts you in a position where you have to raise the money to buy the product, to sell the product, to collect the money. So, and a lot of people don't quite realize this. I had a client who had the theory that she could order the product, and they told her that she had 45 days to pay, that she could order the product and have it all sold in 45 days and pay her bill, and everything would be fine. And guess what happened? She bought the product, the clock started ticking. At the end of 45 days, she only had half of it sold. So, but the bill was due. But she hadn't really counted on that. So suddenly she needs bank loan or an investor or something to help her out. So be careful about your vendor payments. Try to get terms with your vendor that are favorable to you. The least favorable terms with your vendor are COD, cash on demand. We'll deliver it, you pay it. Or even worse than COD, buy it on the internet, put in the credit card company, credit card number, and we'll deliver it in 2 days. Now you've paid for it 2 days before you got it. So pay with terms if possible, but if not possible, get yourself a business credit card where you can pay in 30 days without any interest accruing, and then stick to it. Do not let it go over because the interest rate will be astronomical. Electronic payments can work well, especially if you have a software system that's tied together with the banks and you can control the timing on your payments out. The vendors could be welcome to pay into your bank account, but you have to make sure you've got a reporting system so that you know who's paid and who hasn't paid, so that you can keep your eye on that. And then I'm going to mention Dun and Bradstreet, D&B. There is a firm called Dun and Bradstreet that has a business. It's a private company, a profit-making company. They have a business of providing information about companies to vendors. So the vendor wants to sell to you. So the vendor goes to D&B and says, I want to sell to Tom and Jerry's barbershop. What's their credit look like? And D&B may or may not have a file on you. You can set your own file up with D&B by contacting them and feeding them information. But it's something the vendors like to look at if you're asking them to do anything besides selling to you COD. But a lot of people don't understand how D&B works. They think it might be a government organization, or you have to pay money to get into it. As a vendor, it costs you nothing. As a business person, it costs you nothing. As a vendor, if they want to get a credit report on you, they pay money for it. So that's how D&B makes their money. So let's keep going here. All right, so just to talk about some terminology on capital that you could be bringing into your business. So to start a business, you need money. And where does that money come from? It could come from you. You could save up to start a business, and that would be equity. You put money into the business. You're the owner. All of the assets and liabilities of the business are yours. You're the owner. But if there are no liabilities except maybe some accounts payable, you're running the business debt-free, which is totally possible. But it's also often difficult to grow a business with only using your own money. And that's what debt is all about, is bringing money into the business to allow you to grow. You might think, oh, I'll just grow because I'm selling a lot of stuff. But to sell a lot of stuff, you have to buy a lot of stuff. And quite often you have to take that next step of maybe getting a physical location or buying equipment, even something as simple as a lawn mowing business. If you want to grow, you better have another truck. You better fill it up with lawnmowers and weed eaters and all that other sort of stuff. And quite often, maybe at the beginning of the season, you've got to take some debt. And by the end of the season, you can pay it off. But bringing money into the business is something that's handled on the finance side of the business. Sources of money could be you. You could have other investors in the business. Not people who you're going to pay back, but people you're going to share the profit with. And that could be family, friends, or partners. So keep in mind the finance side of the business. You have to have an eye on where the money's going to come from if you need more. And we're going to talk a little bit about sources of debt in a couple minutes here. So let's have a look at the next slide. All right, so debt. Everybody has their own opinion about debt. I've had clients who say, I wouldn't borrow any money for my business if I can't do it with my own money. I can't afford it. Other people say, I'm not putting a penny more into that business than I have to. Tell me where I can go out and borrow. And I can't say one's right or wrong. It really depends on your risk tolerance. The more debt you have, the more risk is out there, because you have to pay the person who lent you the money first. And you got to be careful that you're not ever running out of cash, that your business has to sort of stop until you can accumulate cash, which is why you want to consider the ability to borrow money if you need it. And that's one reason to have debt, even though you might be opposed to it. A lot of times you can get a line of credit with a bank, which means you don't really borrow the money. But if you do want to borrow the money, they've already agreed that you can borrow the money. Because the simplest way to get debt is through a credit card. It happens too often. And I've even seen clients who've maxed out one card and they've gotten another card and they've gotten another card. It's incredible. It's surprising to me that the second and third card vendors actually let them have those cards, but they do. And those people can get in really bad trouble because the interest rate's so high that they're kind of like on a treadmill. They can't get off of it. So be careful about borrowing, but be careful about not being able to borrow. are not having things lined up if your business is growing. One problem.
Hey, Bill.
Yes.
I will interrupt on this one. Adelita
Right.
was asking, is there such a thing as a self-funded business where the business funds itself? I'll let you go ahead and answer that.
Okay, so the better the cash flow of the business, the easier it is to self-fund. Some businesses are building for the long term. In other words, in the early years, they're not really generating very much cash because they're in the growth mode. Some businesses throw off a lot of cash. But for businesses to be self-funding in the first place, usually the owner doesn't take money out of the business. So the owner of the business is entitled to the profits of the business. And if you have profit at the end of the year or whenever you have it, the owner is entitled to that. It becomes income to the owner. And most of these businesses we're talking about here are LLCs, where the owner's personal tax return is blended with the business tax return. But the way the business self-funds is a decision the owner makes to leave the money in the business. And that's actually what I'm talking about here on this slide in red at the bottom. Be careful about withdrawing so much cash that the debt increases. I've had people come in for mentoring who think the business is not profitable enough and they're running into problems because they're needing more and more debt. But when I look at it closely, they are actually over withdrawing from the business. The business only made $10,000, but they took out $20,000. Well, that extra $10,000 has to come from somewhere. And so for you to take out $10,000 that the business didn't earn requires you to get debt for the $10,000. So and it all goes back to the financial statements. What can the business afford to let you have? And that's not equal to the amount in the checking account. It's equal to the profit of the business, which is a different number. So, Bill, did I answer the question?
Yes, and there's actually a related question. Natalie mentions they have an awful lot of credit card debt. What do I do? Or is there a way of being able to convert that credit card debt into some other kind of debt at more favorable terms?
Okay, the answer is yes. And one of the, on the finance side of the business, the person who is worrying about the finance is the person who should be thinking about where can I get money the cheapest. That same person should be worrying about how can I collect the receivables faster? How can I pay the vendors slower? And where can I get debt cheaper? And as mentioned in the beginning of this, the most expensive debt, short of loan sharks, is credit card debt. And if you back up the chain, a lower cost of debt can come from a bank itself. Even though the bank issued you the credit card, the bank's business loans are at rates much lower than the credit card rates. So you could talk to the bank. The bank will want to know how you're going to pay it off, and you're going to have to show them a forecast that indicates there will be cash generated by the business sufficient to pay the loan. But if there's a problem with credit scores and the bank loan is not possible, we're going to talk a little bit in a couple slides, and I'm going to hold the whole discussion till then, about something called a micro loan up to $50,000. So I'll cover that with the question in mind. Maybe the micro loan could be used to pay off some credit card debt. All right. So we're ready for this slide. All right, here's a topic, budgeting, which most people don't even expect to be covered in a workshop like this because they don't do it. And I, um, I guess I got surprised about this at first, and now I just accept it as the state of affairs of people in small business. When you get started, there's so many things going on that you need to do that seem more important than forecasting and budgeting that you don't ever get around to budgeting. But you need to get around to budgeting. And budgeting is simply looking at your financial statement, especially your income statement, and asking yourself, what will it look like in the future? And projecting it out. So once you get rolling in a business, the expenses are predictable. That is my daily spam call, which I had to hang up on. All right, so the business has predictable expenses. What's unpredictable is the sales, but it is the sales that you're most interested in projecting, because if you can't see the opportunities in the future for sales and sales increases, well, then the business is headed in the wrong direction. So in budgeting, the first thing you actually do is sit down and try to project your sales. And that often causes you to wonder where the customers are going to come from and what categories they're going to fall in and how big the purchases are going to be. And that often leads to a totally different discussion about marketing, which is the other side of business. It's either finance or marketing. Operations is sort of in the middle. But if you can't get comfortable that you're going to have sales or you know how you're going to generate them, maybe you have to think about what are your marketing programs and how successful are they going to be. But you forecast your sales, and then you forecast your expenses, and your variable expenses go along with your sales, as we talked about before. Your fixed expenses are things like your insurance and your rent and your payroll and that sort of thing. When you put those together and it uses the same categories that you have in actuality, you get yourself a forecast and you can see how it's going to look. You got to make it happen, of course. And yet, if you put together the forecast and the profits are lower than you want, you have to ask yourself, so what am I going to do about it? Just sit here, wait for the phone to ring, check my emails every morning and see if I got an order? Or are you going to shake the bushes, find some customers, make it happen, find a new product line, cut some costs? The budget causes you to think about all the things that you have to do proactively. And ask yourself, are you going to be satisfied with the profits? A lot of times people are going to go into business. They need to do the forecast. They go into business, they do the forecast, or they think about going into business. They do the forecast and they say, oh, wow, the best I'm going to do is make $40,000 a year. Am I going to quit my $60,000 a year a job to be an entrepreneur? Is it really that important or interesting or lucrative? So projecting your profit is very important. Then once you get into the period for which you projected, the budget becomes a goal. Do we reach that sales number that I projected? Do we keep our costs within the bounds that I had there? And then you can use your budget to control expenses or to modify your operating plan. Maybe you didn't put enough money into marketing, or maybe the marketing plan isn't paying off and it's a waste of money. So this all starts to come into the discussion when you do a budget. And up there in the second bullet point, I say should be done by the leadership team. You can't really tell your bookkeeper, build a budget. You need the budget built by the people who are owning and running the business, the people who know where the sales can be, what the marketing expenses should be, who've already checked out the rent opportunities or decided on what they need to buy to make the business grow. So budgeting is a whole nother workshop that we could have. And I just want to tell everybody to give it some serious thought, think about it. And maybe if you want to dig into that subject deeper, you could sign up for some mentoring with SCORE, and we could help you out with that, setting up the process. So, Bill, any questions coming in that you want to talk about?
No, I think we're still good. Thank you, Bill.
All right. So let's talk about banking. A lot of times I say to clients, do you have a bank? Oh, I have 2 or 3 banks. Well, why do you have 2 or 3 banks? I don't know. One's nearby. That's where I deposit the money. There's another one. I know the guy, and he gives me a little bit of financial advice, and I don't know why I have that third one. I just got that account started, and I haven't closed it. I would suggest you'd be better off trying to do everything with one bank so that you become a little bit more important as a customer. And I would also want you to be sure you have a separate bank account for your business. Do not just piggyback on your personal account. You'll run into all kinds of problems with that, and it's a very bad practice. You can open up the bank account in any name you want. The bank doesn't really care if you want to call the bank account Tom and Jerry's Barbershop. They don't care. All they care about is give them your social security number. And if you're an LLC, give them your own social security number because the LLC doesn't have its own. That doesn't matter. What matters is keeping those records separate. Because if you do everything systematically, if you make all your deposits into that same bank and you pay all the payments out of that same bank plus your credit card, all your records are there if you need them. So in worst case scenario, you can figure things out even going backwards. But I'd suggest one bank. But make yourself known. Tell the bank. Even they're all these banks are branches, of course, but find out at that branch who the business banker is, introduce yourself, tell them you're opening up a business account, tell them you're interested in making sure they tell you about all the services they offer. And if you should have to borrow in the future, start there. Talk to them. Say, I'm already a customer. Here's what's going on. Keep them up to date on your business. The frustrating thing, and this is down in red at the bottom, is that the bankers change quickly, frequently. If you have the same person at the bank for more than a year, I'd be surprised. So the burden's on you to keep your relationship alive. So borrowing tips, this continues right on from that. Be prepared when you're talking to your banker. If you're seriously wanting to talk to them about borrowing money, don't be unprepared. They are going to ask you questions. And even a simple question like, well, how much are you thinking about? And you say, oh, I don't know, $20,000 or $30,000. That's a bad answer because it shows that you don't even know how much money you want to borrow. You know, if you tell them, well, I need $25,000 because we've calculated that over the next 6 months, we need to grow and we need to invest that in the business. And then beyond that, we're in good shape and I can show you the financials if you'd like to see them. That's the kind of answer they want to hear. So be prepared, have facts and details, find out what their process is for loans. Eventually, they're going to tell you you need to show them a business plan. That's because inside the bank, other people are going to have decision-making power, and you're not going to be there to speak for yourself. So the plan you put together has to talk for you, and it has to answer all the questions. And Adelita says borrowing is scary. Agreed. Bill's working on the question right there.
Yeah, Bill, let me, if you can, because Rose asked a series of questions that sort of covers several of the slides that you had. Her first question was, well, how do you budget in these uncertain times? And I answered her separately. I said, good question. But she had an excellent question that really follows here on borrowing tips. How do you determine whether or not I should be borrowing more money and investing in the business, even though I might be generating losses to keep it open? Or how do I make that decision whether or not maybe COVID or the economic situation is such that why do I want to put more good money into, or more good money into bad, or something to that effect? It's a tough question, but I know that you faced some of those questions in the past, and how would you answer that?
So first of all, the question about uncertain times, I'd have to say, as a person who's had my career has kind of come and gone, and I would say that all times are relatively uncertain. It always seems like if you ever thinking about investing in the stock market, you're always going to read these articles that tell you, well, why don't you maybe wait because an election's coming? Oh, why don't you maybe wait because after the first of the year a new tax law changes? Oh, why don't you maybe wait because Brexit's out there? So I guess the uncertain times is normal. That now the times that we're in with COVID are different than ever before for us because none of us are over 100 years old and didn't experience the last pandemic. But I think it's pretty clear right now that there's winners and losers from the pandemic, and some things have changed forever. And if you're in a business that is on the short end of the stick here, is in the losing side of things, the extreme example would be if you're running a discotheque, forget it. People are becoming very conscious about how diseases are transmitted, even colds and the flu, and packing people into a place like a disco, and I'm using an archaic word from the 1970s, but you know what I'm talking about. The handwriting's on the wall. It really is. But most businesses are into products that people do need, but need to change the way they're doing business, and maybe permanently. I don't know, maybe my wife will always have the groceries picked for her so she can pick them up without going in the grocery store, even after COVID, because we just found out it's darn convenient. So in terms of thinking through where your business is going, that's what I'm talking about here is budgeting, which is usually like a 12-month period. But there's another layer called strategic planning, which is more like a 3 to 5 month period. And that's where you really look at the very fundamentals and get very serious about what the options are. We've done workshops on strategic planning, but it's an important thing for businesses to do, although even like budgeting, even less people do strategic planning because that's always something that seems to be able to be put off into the future. But I think you might have to kind of have that hard self-discussion if your business looks like it's permanently going to be affected by the changes that have occurred in the whole healthcare environment. I can't predict the future, but it's obvious now that there's no like instant switch. Suddenly you wake up on Monday morning and the newspaper reads, COVID over, everybody back to normal. Thanks for having a good, safe journey. It's tough, but you might, again, maybe with mentoring, you might want to talk to somebody about, the big picture, and they can ask some of those hard questions or get you thinking in the right direction. But it's important that you're thinking about that. You can't really count on going from government program to government program, because eventually they'll even the next program, the second one, is having trouble getting off the ground. The first one came kind of fast, but I don't know, Bill, what do you think?
Yes, the part that you mentioned, the strategic plan, a lot of it is just understanding if the traditional form of my business is not working, have I found a way to pivot or to find alternative revenue streams, or by working with my vendors, because your vendors don't want you to go under either, especially if you owe them money. So many will work with you. It's one of those critical items of what do you see? If we all had that perfect crystal ball, they would be easy. And some of those are very difficult decisions. Deciding what you do with your business is probably more difficult to do than starting your business. So it's really one of those, it depends, or what are my what if scenarios? And this would be a perfect opportunity to, I would call it out, set up a mentoring session with Bill or I, or we have over 80 mentors within the organization in the different groups. And this might be a time to really talk through your thought process.
Okay. I was just starting this slide, and be prepared when you're talking to the banker, have your facts, business plan. All right. A rule of thumb when you're borrowing is that if you need some money, they want to make sure that you yourself are also contributing some money. Now, this 20% rule is like starting from scratch in the business. You need $100,000 to open the door. They would want you to put in 20 and they'd put in 80. If you're getting a loan in the middle of your business cycle, that isn't the relevant point. The relevant point there is the financial statements proving that your business is able to generate enough cash to pay the principal and interest off over a period of time. And the nice thing is, when you spread a loan over 3 or 5 years, the monthly payments are really quite small, and should be able to allow you to not only pay the loan off, but to have some profit for yourself. Understanding the collateral value of your assets. Banks want to secure the loan the best they can, and that means asking you to give as collateral some things that you might own, even though it's a business loan. If you're an LLC and you've been in business for only maybe less than 3 or 5 years, your personal life and your assets on the personal side are very important to them. So understand what you have in terms of assets that could become collateral. It could be paid off vehicles, equity in your house, that sort of thing. Know how much you want, exactly how much you want, and have a list of what you're going to use the money for. They really don't want to hear I don't want to borrow the money just in case. You can, if it really is just in case, you should be talking about a line of credit and not a straight out loan. Personal credit scores matter. Absolutely, personal credit scores are going to be something that you either have the ability to interest the bank in talking to you, or you don't, and they're going to say something if it's too low, like, you should really work on that credit score. When it gets to this level, why don't you come on back and we'll talk about this? And it's not really negotiable with the banks. So keep that in mind. However, with microloans, it is a bit negotiable. And I guess we'll get to that in a minute or two. And I just put this bullet point in here. There are no grants. People sometimes get in touch with SCORE and say, can you point me to some grants I could get for my business? There have been now with COVID some programs that have turned into grants, but they're well known. They're in the news. Everybody pretty much knew about those. So, okay. Successful growing firms are actually the ones that often need money the most because they're building their inventory. If you want to open up another store, you got to fill the shelves. That's all inventory. Or if you want to expand your landscaping business, you need vehicles. Or you want to have another location for your hair salon, you need nail salon, you need facilities, you need to get equipment to put in there. So growing businesses are the ones that actually need money. Sometimes you want to invest in increased staff, because if you could hire them, they'd more than pay for themselves by increasing sales. So you can generate funds internally, as we talked about, or externally. And the external part,
Sorry about that.
is debt or equity. And I outlined that earlier. What is debt and what is equity? Where debt is from a lender and equity is from an investor. You have to share your profits with the equity participants. The debt would be a loan or a line of credit, and equity, as mentioned, owners or investors. So now you can flip one slide and I'm wondering where my slide is where I mentioned micro lenders. If we don't get to it by the end.
It's in the next one, I believe.
Okay.
And in fact, let me interrupt because there were a couple more questions with regards to that. One of the questions was, are there other sources that are not banks that can lend money that are not scammers?
Right.
And this is where you get into the microloans, crowdfunding. I had one client specifically in the music business, and one of our other mentors mentioned Indiegogo, or there was another one that I'll send the links to, that specifically, or angel investors that will specifically say, you know what, I'm interested in helping these types of industries, whether they're loans or they're grants. Natalie mentioned in California, she was able to obtain a $1,500 loan from Chambers, or the SBDC, maybe other sources. So especially under COVID, this is, we may not have all the answers, but do some Google searches and see what might be out there.
Okay. I'm just flipping through my slides here, and
did we miss one?
I don't think we missed one, but I might have confused myself. But let me just take a sidebar here.
Okay.
And talk about the category of microloans, because they're an interesting thing. There are micro lenders in Indiana who are not-for-profit organizations. So banks are clearly for-profit organizations. Although I have to say credit unions, which are very much like banks, are member-owned, which makes them essentially not-for-profit organizations. But these micro lenders are not-for-profit organizations. The money they lend out, they receive from entities like the SBA or some economic development corporations. And the purpose is to create a source of funds that is for people who are not quite bankable. And the reason they aren't bankable is because they don't have a track record in business, or their credit scores are not as high as the banks would like to see. And there are two microlenders who operate in the Marion County and surrounding county areas. One is called the Business Ownership Initiative, the BOI, and they are located in Marion County, and they are affiliated with the Indianapolis Chamber of Commerce. And the other one is called bankable.org, right, Bill?
Yes.
And that's how you find them, is their website, bankable.org. And they are physically located in Anderson, Indiana, but they serve the same counties as the Ownership Initiative. And they have a really nice website, and they are quite large in terms of how much business they do. And I've had a number of clients who have used them, and they're really straightforward. Both of these organizations will talk to you on the phone, will tell you exactly what they need, will tell you if it's going to work, it's not going to work. It's not like, well, we got to send this to the headquarters, and it takes our committee a while to come together and all that. It's really straightforward and easy. And the loans that they have are up to $50,000. And I have had clients who have consolidated credit card debt. That was the whole purpose of the loan. They had 3 credit cards with exceedingly high interest rates, and they switched it to a bankable loan, and it was the right thing to do. So that's on the list of possible sources of debt. All right. Now to this slide, purchasing. When you're in the purchasing process, you're responsible for getting the best price and the best terms. So a good purchasing agent, which none of you probably have a specialized person like you do in a large corporation, just handling purchasing, but it's a task that needs to be done that affects their finances. You're always going to be wanting to not buy more than you need, not buy things at higher prices than necessary, and get payment terms that are the most favorable for you. Pay as late as possible. So keep in mind that purchasing is a important component of the finance side of the business. And if you are using the product to resell, be sure that you're using your tax exempt status as a merchant, so that you're buying it without paying sales tax, and then you in turn collect the sales tax when you sell it. You don't want to be paying sales tax even though you're collecting sales tax, because the sales tax you collect, you're going to have to remit. So if you buy and pay sales tax, you're actually paying double tax. But people can't sell to you and avoid charging you sales tax unless you have your merchant certificate, which you get from the Indiana Department of Revenue. So keep that in mind. Okay, next slide. And we're doing great on time here. It's a little bit after 1 o'clock. We're going to go to 1:30. We're getting the questions answered as we go, and we're probably only 3 or 4 slides from the end here. Inventory control. So all of that stuff that you have that you're going to eventually sell is your inventory. And when you buy it and have paid for it and it sits there and you haven't sold it yet, that's a drain on your cash. It's money that isn't in your pocket. It's not money that you're using to pay back your loans or to pay yourself. So it's a fine line. Stores especially have to balance between having enough inventory so that the customers get good customer service. You don't want to walk into a place and look for your size on the shelf and it's not there. And then they tell you, oh, we can order that. We'll have it in 2 weeks. You pretty much, people expect to buy stuff that's there. So you have to have it. But then if you have stuff that doesn't move and eventually you don't sell it or you have to mark it down, then that's hurting your profit. So inventory control, again, is part of the finance side of your business. You can monitor the level of inventory on your financial statements. It could be on your balance sheet, your inventory levels. And you also, and this has come out with COVID especially, you have to understand your supply chain and the risks you're taking. Some businesses found out that they only had one vendor that they were counting on for a lot, and suddenly that vendor was hit with problems like they had with the chicken pluckers had to shut down because all of their factories became infested with COVID, and then the people who were buying the chickens didn't have anything to sell. People have found that they're buying things from China, and then suddenly there's a trade war going on, and the tariffs from the stuff from China go up, and they have to pass that on to their customers, and they don't have any alternative vendors. So understand your supply chain and the risks that are involved. A lot of businesses try to find backup vendors even when they don't need them. And sometimes you find a backup vendor and you can talk to the vendor and say, we're not buying from you now, we're buying from them. But if you could give us the same price, or if you could give us better terms, we would switch to you. And that's a whole nother process that you can use to increase the profitability of your business. So, Bill, anything on inventory you want to say, inventory control?
Just, yeah, for me, the toughest part is always about obsolescence. Finding that right balance of the right products you need at the right times. And so monitor your inventory turns to understand how your inventory moves. Otherwise, you may have it on your shelves and you can't sell it.
Yeah, that especially comes in technology. If you've got an HVAC company and you've got these thermostats that you sell, well, the thermostat they sold me 2 years ago, if they tried to sell it to me today, I'd laugh at them because the new ones are so much more sophisticated. You just get near them and they light up and they tell you how long it's going to take to heat your house, and they tell you if you're energy efficient and all that. So cool. Yeah, with technology, you've got to especially be careful about how many of each product you have because of the obsolescence factor. Okay. So leasing versus borrowing, I wanted to throw this topic in because a lot of people don't think about leasing the way I do. Leasing is the same as borrowing, period. Leasing is the same as borrowing, except the person who's lending you the money is the leasing company, not the bank. So for many items, you really have a choice between three things: paying cash, leasing the item, or borrowing the money from somebody else and buying the item. And those three alternatives should be thought about as alternatives. Just because you want to get a truck doesn't necessarily mean you have to lease it through the truck seller. Maybe they are the best place. Sometimes they are, because they are very interested in pushing their products, and that's kind of like the sweetener to the deal, that they give you good financing on it. That's totally possible, but it's not always the case. And the other hitch is sometimes you lease things, and at the end of the lease, you don't own it. And then the way to own it is to make a lump sum payment at the end. And if you add up all the payments plus a lump sum, you realize, wow, I paid a lot for that. If I just bought it for cash in the first place, I would have paid a lot less. So what are your plans at the end of the lease? If you're saying, well, I'm buying this and I'll get this truck and I'll run it up to 300,000 miles. I'll run it till it can't run. Well, maybe the lease is the best way to go on that. Maybe buying it is, so that you own it from day one, and so that you can put the maintenance in and benefit from that. So consider, when you're thinking of leasing something, understanding what the built-in interest rate is and comparing that to a bank loan, or using the cash that you have on hand. Okay.
Or Bill, the key with leasing is there's many restrictions with regards to how you can use it, how long you can use it, how many miles, especially with a vehicle, you can put on it. But even a copier or the equipment that you use in your business may have restrictions. So understand how you're going to use it, because that might also consider. I know that, for example, a real estate company or realtor, they feel that they always needed to be in a new car to take their clients. So to them, leasing a vehicle that they're going to swap out every 6 months or every year or whatever may be more practical, but that may not work for someone who's driving very, very long distances, and then may incur penalties because they're exceeding the use of the vehicle or the equipment itself.
Right. The last bullet point here, I think, is the key for me. The last two. What if you want to cancel? And what does the contract say happens at the end of the term? Do you own it outright? Do you buy it? What do you buy it for? It used to be a lot of times they would put in there, you can buy this for the fair market value. And then it sounds wonderful until you get to the end of the lease, and they say, okay, the fair market value is such and such. And you say, well, where'd you get that number? And they say, well, that's what we use. We're the specialists on that. We know what those things are worth, and that's the fair market value. And you're saying to yourself, oh, wow, that doesn't sound like the fair market value to me, but they're the ones that suggest what the fair market value is. So anyhow, open your eyes to leasing. It might be good, it might be bad, but it's something to think about from a financial point of view. Okay. I think this is the second last slide, tax management. Yes. The one thing that I've found from mentoring is that if the firm or business is using an accountant, they're using the accountant for taxes, period. And the good news is they're probably getting their taxes done correctly. The bad news is they're not getting any other financial information that they really need to run the business, because the tax accountant really is being hired to file a tax return, which is a process of taking your records for the whole year and filling out the forms and telling you what you owe and being done with it. So keep in mind that just because you have a tax accountant doesn't mean you have a financial advisor or an accountant in general. And there's a lot more information you could be getting from your bookkeeping system than just the ability to pay your taxes. Also keep in mind that all the tax liabilities are yours, and you're the one that goes to court, gets fined, goes to jail or whatever. There's federal taxes, there's state taxes, there's local taxes. If you have a payroll, there's withholding taxes. And if you don't remit the withholding taxes, that's a very serious problem for you. If you sell things and collect sales tax, if you don't remit the sales tax, that's a very serious problem for you. And unfortunately, I've run into clients who have had this problem both ways. And it's always like, well, we didn't have the cash. I thought I would catch up. I knew I was going to be late. And then time marched on, and I really did never have the cash. And it seemed okay because I never got any notices. And then, holy mackerel, they've seized my bank account. Now what do I do? So the government works very slowly, but very steadily. You can't get away with it. So be careful about that. A tax professional can often pay for themselves as things get more complicated in your business, but don't pay them to take a box of records and straighten them out. Keep your books, make everything up to date, and just have them do your tax return. And if you get the same person that can both help you with taxes and help you analyze your financial statements, all the better. Just don't assume that the tax guy even has any interest in that part of your business. Some do, some don't. Okay, final thoughts. Before I read through these final thoughts, Bill, what are there any questions out there?
There was one that might be relevant now. Dan asked, it was part of one of your first slides, in terms of the accounts and record keeping, can you have too many accounts? Is there a general rule of thumb of which accounts to keep? He was making a statement, my tax accountant or my bookkeeper says I have too many. And I responded to him, well, it really all depends. And it's really a choice, but I wanted to, I'll let you respond to that as well.
This is an art, creating the chart of accounts that is useful, but keep in mind that the way the software is set up, you can always drill down. So if the account says travel expenses, you could put a lot of stuff in there. But if you want to see the details and you're using a software system, it's just a click away. So you really do want to have layers so that the very highest level are categories everybody can wrap their head around. You don't want to have a miscellaneous category that has anything significant in it is a huge mistake because it tells you nothing. Every category should tell you something about your business. Is it marketing expense? Is it sales expense? Is it commission expense? Is it insurance expense? Is it rental expense? Those are things people can wrap their heads around. But if the category is miscellaneous and you have to look at everything in that category, that's bad. But if it's like the category is a bank fees for checking, bank fees for credit card, house insurance, boat insurance, car insurance. Those aren't categories. That's a laundry list. So if the accountant's suggesting you have too many categories, you probably just need to say, what can I group together? And you won't lose any details. It's all there behind the scenes. But people have different purposes of looking at these things. And it's also easier sometimes to budget a bigger number in a bigger category because you get offsets. So
yeah, I think it's a function of your experience. And as you manage your business, you find out that categories become more important than others, and you need to add categories as you go. So a bookkeeping system such as QuickBooks easily allows you to add or even combine accounts. To take your example of travel, when you first start out, you might just say travel. As you add different salespeople, or you end up, we're going to fly more, you may want to break it out between hotel for overnight stays and airline tickets. So it might be something that you can just drill on so you can negotiate better when you need that type of information. So it becomes a function of your experiences over time and how much detail you need to manage your business.
Right. Sometimes the template that you get with a software that has categories suggested actually reminds you of some categories you forgot. So it evolves, and it's always changing. You don't have to stick to these at all. You can keep reshuffling. The numbers are all there. It's always going to add up. It's a display question. So last slide. This has been good. It's been fun. The only thing I've got a note to self: put in the micro loans. I don't know unless I skimmed over that, but I'll check that. But final thoughts, and thanks for everybody for coming today. Run your business by the numbers. Get to the point where you know if you're making money, you know if you're throwing off cash, you know if your revenue is growing, you know if your gross profit margin is growing. Just knowing this allows you to be more proactive and actually manage the business. Cash is king. That's a phrase that is always true. Even the best businesses, they sound good on paper. If they can't generate the cash because they're just tying up too much in machinery and equipment and inventory, it's a problem. You got to figure out how to get the cash out of the business. Keep your records, keep them systematically. Don't just say, I've got all the records because I did everything on a check and I have a checkbook and I can go and look through it. You've got to build the financial statements. And I recommend doing that through your system once a month so you see where you stand. Build a budget and measure results against it. Again, I know 90% of people who are watching this morning do not have a budget. And if you do one thing different, move in that direction, and you'll be amazed at the benefits of that. And not covered at all, have an exit strategy. Maybe we did cover it with the one person who said, holy smoke, should I put more money in my business, or should I think about, is it worth it anymore because the world's changed with COVID? Think about, where are you going with this business? What is this what you want to retire with, sell your business? Is this something you want to work on for 5 years and sell it and start another one? Think about what's coming at the end. Think a little bit strategically about that. Don't just let it roll and roll and roll. So that's what I have. That's all I have. This is being recorded and will be posted to our YouTube channel, which you can find at on the YouTube search engine, Indianapolis Score. You can see all the webinars we've had since March. There's 8 or 10 by now. We are going to send you a follow-up with a link to the recording, and we're also going to send you a copy of these slides, which Bill will send to me, and I'll pass along to the people who are helping me put the thank you letter together. So that's it. Thank you for participating. We got to 125, which is, I think, close enough to 130. And Bill, any final?
Just as you mentioned, feel free to contact IndianapolisScore.org if you want to meet with a mentor. There's a lot of subject matters that were covered today, some that were a little bit specific, and I sent my information. If you want to connect with me, we can set up a mentoring session or with other subject matter experts. For example, there was one question on commuting expense. Commuting expense is one of those tricky areas. A regular commute to and from your office that you do every day is not an expense. That's a personal expense. That's part of your charge. But if you operate from your office and visit different customers in different areas as part of your territory, that may become an expense that you can charge to the business. that's where your tax accountant can really help you out with. But we certainly encourage you to contact us and set up mentoring sessions for any issues that you may have, including sessions of today or other subjects that you may have.
Great. All right. Well, we won't keep you any longer. Thanks a lot. And you're on our list for future webinars. Take a look. We've always got a couple every month, and I think the topics are pretty interesting. So, Bill, thanks for helping me out. And everybody, have a good day. Bye.